Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Unity Software Inc. Annual Report. Unity Software Inc. offers a wide range of services to support game development and deployment across various platforms. The company's platform provides artificial intelligence solutions that cater to developers throughout the entire development lifecycle, from prototyping to monetization. The company's offerings include Create Solutions, which enables developers to build, ship, and run real-time 2D and 3D content. Additionally, Grow Solutions allows customers to grow their user base and monetize their content. Enterprise support and consumption services are also provided, along with professional services such as consulting, platform integration, training, and custom application development. Unity Software Inc. also offers advertising and game publishing services, which can be accessed directly through its online store or through field sales operations, independent distributors, and resellers. The company's solutions cater to a diverse range of clients, including enterprises, mid-market companies, government institutions, nonprofit organizations, small businesses, and individuals from various industries. Overall, Unity Software Inc.'s comprehensive platform provides developers with the necessary tools and services to create, deploy, and grow interactive experiences across multiple platforms. Unfortunately, I don't have access to the text you provided. However, I can still provide a general overview essay on what might cause a stock price to drop. The stock price of Unity Software Inc. has dropped slightly over the past year due to several factors. One possible reason is the company's increased competition in the game development market. As more companies enter the space, Unity may struggle to maintain its market share and revenue growth. Another factor that could be contributing to the decline is the shift towards cloud-based gaming platforms. With the rise of cloud gaming services like Google Stadia and Microsoft xCloud, some developers may be opting for these platforms over traditional game development tools like Unity. Additionally, economic uncertainty and market volatility can also impact a company's stock price. If investors are cautious about investing in tech stocks due to concerns about inflation, interest rates, or other macroeconomic factors, it could lead to a decline in Unity's stock price. Lastly, the company's own performance and financials may be under scrutiny by investors. If Unity fails to meet its quarterly earnings expectations or experiences delays in product releases, it could negatively impact investor confidence and cause the stock price to drop. Unity Software Inc. market capitalization of $8 billion is significantly larger than the average industry peer of roughly $2 billion. This shows that Unity Software Inc. holds a significant advantage in their industry. Unity Software Inc. trades at a higher price-to-book ratio of 2.6 times relative within the industry. While the stock does not screen as absolutely cheap, mixed valuation signals relative to industry peers prevent a definitive conclusion. With the broader industry trading at lower valuation levels, this may reflect transitional pricing dynamics rather than clear mispricing, warranting further analysis of earnings quality, growth sustainability, and balance sheet strength. The company maintains a moderate leverage profile, with liabilities making up 49% of total assets, suggesting a balanced approach between risk management and capital efficiency. Liabilities have increased, while assets and equity have failed to keep pace or declined. This suggests the business is not growing and may be in decline, making it a highly unattractive investment from a risk perspective. Shareholder equity has increased on average, but the growth is not consistent year over year. This may indicate one-off events such as asset sales or capital raises, rather than durable business performance. The share count has increased over the past 5 years, while revenue has continued to grow. This suggests the business may rely on shareholder dilution to fund expansion. Investors should closely monitor whether growth can eventually be sustained without dilution. The income statement shows that the company have been growing its revenue annually, but the operating income have not been increasing. This shows that the business is under pressure with rising cost. The primary drivers of revenue growth or decline in a company are multifaceted and influenced by various factors. A decrease in revenue from 2023 to 2024, minus 16.5%, was followed by an increase from 2024 to 2025, 2%. This fluctuation can be attributed to several key metrics, including the growth rate of Create Solutions subscriptions, which contributed positively to revenue growth. The drivers of revenue decline were largely due to a decrease in unbilled receivables and amortization costs. Additionally, the recognition of deferred revenue had a negative impact on revenue growth. On the other hand, the increase in Grow Solutions revenue, including monetization solutions and game publishing services, was a significant driver of revenue growth. The geographic breakdown also played a crucial role in determining revenue growth or decline. The United States experienced a decrease in revenue, while Greater China saw an increase. EMEA and APAC regions also witnessed a decline in revenue. Overall, the company's financial performance was influenced by these various factors, resulting in a net loss that decreased from 2023 to 2025. Net income has been a persistent issue for the company, with losses recorded in each period since inception. The net operating loss carryforwards decreased significantly, indicating a substantial reduction in potential future tax benefits. Despite some improvements, net income continued to decline due to various factors. One major reason for the decline is the increased competition from alternative solutions and lower prices offered by competitors. This has put pressure on the company's pricing power and revenue growth. Additionally, restructuring efforts and potential loss of accumulated knowledge have also contributed to the decrease in net income. Profit margins have likely decreased due to rising operating expenses and costs associated with investments in research and development, sales and marketing, and technology infrastructure. The gross margin was negatively impacted by an increase in hosting and other direct costs to support revenue growth. Furthermore, increased amortization expense and employee separation costs also weighed on profit margins. The company's profitability has been affected by various external factors, including government demand and payment cycles, contracting requirements of governmental or regulated entities, tax liabilities, and tax rate changes. Uncertainty around tax laws and regulations may also impact future profitability. Overall, the decline in net income and profit margins is a result of a combination of internal and external challenges facing the company. The company's financial performance indicates a significant improvement in its ability to generate cash from its core operations. According to the latest figures, the net cash provided by operating activities has reached an impressive $422,955,000 in 2025. This substantial increase in positive operating cash flow is a testament to the company's efficient management and effective implementation of strategies aimed at optimizing its financial performance. The confirmation of this information on page 54 further reinforces the notion that the company is indeed generating positive operating cash flow. This development has significant implications for the company's future prospects, as it enables it to invest in growth initiatives, pay off debts, and reward shareholders through dividends or share buybacks. Overall, the company's ability to generate substantial positive operating cash flow positions it well for long-term success and sustainability. The company's debt level and interest expenses have undergone significant changes over the past year. Initially, there were fluctuations in interest expenses, with a decrease of $465,000 from 2024 to 2025 on page 45, and an increase by 2% from 2024 to 2025, $23.542 million to $24.007 million on page 51. However, these changes were short-lived, as the interest expense increased significantly due to amortization of new debt issuance costs on page 49. The company's debt level also experienced notable changes. The repurchase of $688 million in 2026 notes in Cone 2025, page 53, and the increase in current portion of convertible notes to $556,451 in 2025, from $0 in 2024, on page 56 indicate a reduction in debt levels. However, the debt level as of December 31, 2025 was $2.2 billion unsecured convertible notes outstanding, which is a significant increase from previous years. In summary, while there were initial fluctuations in interest expenses, the overall trend suggests an increase in debt levels and corresponding interest expenses. The company's decision to repurchase debt and issue new convertible notes has resulted in a substantial increase in debt levels, indicating a shift towards more aggressive financing strategies. Management's primary focus is on achieving profitability on a GAAP basis, which will be achieved through strategic portfolio management and right-sizing investments. The company aims to expand into adjacent business areas or new industries, competing effectively in a fragmented market with multiple competitors. To stay ahead of industry trends, innovation is key, along with building strong relationships with customers through high-quality support and services. Management acknowledges the risks and uncertainties associated with fluctuations in demand, seasonality affecting revenue from Grow Solutions, and uncertain macroeconomic conditions. However, they are committed to pursuing growth and development opportunities, investing heavily in sales and marketing resources to develop their growth strategy. The company plans to reset its portfolio by focusing on strategic investments and exiting non-strategic businesses, which may involve reducing the workforce by 25%. This restructuring plan is crucial for the company's success, but management emphasizes the need for efficient execution to avoid business harm. Overall, management's outlook is centered around achieving profitability, expanding into new markets, and prioritizing security and data protection while navigating various risks and uncertainties. There is no mention of acquisitions or divestitures in the recent financial report. The company has not made any notable transactions involving the purchase or sale of assets or businesses. This suggests that the company's strategy remains focused on organic growth and internal development, rather than external expansion through mergers and acquisitions. The company's financial strategy is centered around its shareholders. One notable aspect of this approach is its decision regarding dividend payments. According to available information, the company has chosen not to distribute dividends to its investors. This stance is expected to continue in the foreseeable future. In contrast, the company has implemented equity incentive plans that allow it to buy back shares from the market. Through these plans, the company can repurchase its own stock, potentially benefiting shareholders by increasing their ownership percentage and reducing the overall number of outstanding shares. There are valid concerns about inventory buildup and supply chain disruption. The current situation is exacerbated by various factors, including increased hostilities in Israel that affect operations, cyber attacks on the supply chain, and ransomware attacks leading to significant interruptions or outages. These disruptions can have a ripple effect throughout the entire supply chain, causing delays and shortages of essential goods. Furthermore, potential risks due to third-party vulnerabilities and attacks add another layer of complexity to the issue. The mention of office closures on page 65 suggests that some level of disruption to operations is already occurring. The cumulative impact of these factors poses a significant threat to the smooth functioning of supply chains, potentially leading to inventory buildup and disruptions in the delivery of goods. That concludes the financial summary for Unity Software Inc. Feel free to comment below, and I will be happy to answer them when possible.